Hi everyone, welcome to Financial 101 video series. This is Victor, co-founder of The Fifth Person. So here at Fifth Person, we help retail investors to look for great businesses to invest in so that they can grow their wealth safely and consistently over time. So today I'm going to be talking about earnings per share and how to use it when analyzing a company. So at the end of this video, you should get a clear understanding of what earnings per share is and how do you apply them. So if you're ready, let's go. So I believe you definitely come across this term called earnings per share, or this short form called EPS. It means earnings per share. So this earnings per share is one of the most commonly used financial figure when it comes to investing. And the formula of earnings per share is net income divided by the number of outstanding shares. So why there's a number of outstanding shares is because when a company gets listed on the stock exchange, right, there's always a certain number of shares that is floating in the market for investors to buy and sell the stock. Okay. And this earnings per share actually measures how profitable the company is on a per share basis for the shareholder. So the question here is, why is investor so focused or so emphasize their attention on earnings per share instead of net income? So let me show you an example. Let's say you have two companies, company A on your left and company B on the right, and I say that both companies, right, they make the same amount of revenue every year, so 600 million for both companies. And if right now I were to show you that company A, right, is making a net income of 150 million and company B is making a net income of 100 million, based on what you are seeing here, right, based on your reaction, you might be saying that, company A is better than company B. But what if I'm going to show you right now the number of shares that each company have floating in the market? So right now, if you look at company A, right, they have about 100 million shares floating in the market, and company B have about 10 million share floating in the market. So if you take 150 million divided by 100 million, you'll get about 150 earnings per share for company A and $10 earnings per share for company B after you take 100 million divided by 10 million. So by looking at the full picture right now, based on the earnings per share, right, you can definitely see that company B, right, is a far better choice compared to company A on an earnings per share basis. So this is why it makes more sense to look at earnings per share as a comparison tool, because it really shows you the actual value per share that a company is worth, something that you cannot tell, right, just by looking at net income alone. So in general, right, the higher the earnings per share is always better than the lower earnings per share. So the question right now is, so where can you obtain the earnings per share from? So one of the most common places is to look at the 10K report or the annual report of the company. So right now I'm showing you the annual report, or say the 10K report of Alphabet, which is the parent company of Google. So under the income statement, right, you can see that they have the net income of the latest 9 months, which is about 23.7 billion if I round out to one decimal place. And you also can see that they have an earnings per share already calculated for you over here, which is $33.83. So if you can see, there's two types of earnings per share. One is what we call basic, and what I'm showing you is called the diluted. So the difference between the basic and diluted, right, is the diluted accounts for all the possible dilution that will happen in the near future of the company, where they already issue, like say, stock options or warrants, but it haven't converted yet. So to be very conservative investor, right, we should always look at the diluted income figure. So in this case, right, they already calculated for you. Just in case that you do not know, or maybe the company didn't calculate it for you, you can always take the net income over here, and you as you control F on the annual report, and you can search for number of shares, and you come out to this page where they already show you the different number of shares for Alphabet. So in Alphabet case, right, they have three class of shares, which is class A, class B, and class C. So if you look at the net profit is over here, and the number of shares is over at the bottom. You can see that. So different class of shares that you own, right, there's different number of shares over there. So if you divide it by the earnings by the number of same class number of shares, right, you will get the same earnings per share at the bottom, which you can see $33.83. So this is where you can look for your number of shares and calculate your earnings per share. So this is the earnings per share. So the next thing I want to tell you is that why do we look at earnings per share is because share price move in tandem with the earnings per share. which means that, right, over a long term, right, the company's earnings per share growth, right, should be roughly the same as the share price growth of the company. So let me show you what kind of trends that we want to look at. So this is the most ideal trend that we want to look at, growing earnings per share. And we want to avoid companies with decreasing earnings per share, and also companies with very lumpy earnings per share. So they are not going up or going down, but they are in lumpy up and down, okay? And usually we want to look for at least a track record of 5 to 10 years. So why do we want to look for track records? Because successful company leave a trail behind. So if a company have a track record of consistently increase their EPS, then there's EPS, that means that they have a tendency to continuously increase in the near future. So we want to buy into companies that has more high probability that they will increase their earnings per share. But whereas if you look at a company have consistently decreased their earnings per share, then the probability of them increasing, right, may not be that high. So remember to always look for at least 5 to 10 years of track record. So now I'm going to show you some example of companies that fulfill all these trends that I'm showing you, and how their share price look like compared to their earnings per share. So the first company I'm going to show you is this company called Apple. And I believe most of you should know Apple. They are the maker of iPhones and MacBook. And you can see that Apple's profits or net income have been consistently increasing. So from 2010 to 2019 is on the increasing uptrend. And if you can calculate the compound annual growth rate, right, they have been growing at 20.9% per annum from 2010 to 2019. So now let us look at what happened to Apple's share price at the same period of time. So if you look at Apple's share price from 2010 to 2019, right, the earnings per share have grown by 20.9%, which I showed you just now, and you look at the share price about 21.7%. So what I'm showing you right now is the proof that the earnings per share do move in tandem with the share price over a long period of time. And let me show you another example of companies with decreasing earnings per share and what happened to their share price. So this company is what we call Bed Bath & Beyond. So they are an American chain store of domestic merchandise retail store, you know. And basically they operate within the United States, Canada, and Mexico. So you can see that Bed Bath & Beyond, right, in 2010 to 2015, right, their earnings per share have been increasing. So definitely their share price also have been increasing. But from 2015 onwards, you can see that their profits have been declining. And there's a sharp drop in 2019. So every time when you see this, right, you have to really check what's the issue that the company is facing that caused the net profit to decrease. If it's going to be prolonged, right, you do not want to be in that company. You want to avoid decreasing earnings per share. So you need to understand whether the situation is temporary or is it permanent. And if you can't understand it, it's best to avoid. And you look at Bed Bath & Beyond, right, their earnings per share decreased from 2015 to 2019, and what happened to the share price? Their share price also decreased from 2015 to 2019. Okay, you can see the decreasing trend in their share price. Next is, let us look at GameStop Corporation. So GameStop Corporation is an American video game or consumer electronics and gaming merchandiser retailer in the United States. And you can see that their profits have been up and down, very lumpy in nature, up from 2010 to 2011, then it decreased in 2012, and it decreased into negative region in 2013, and after that it suddenly increased back up. And now in 2019, right, they also decreased to a negative region. And if you look at their share price, right, it's also very lumpy in nature. So you can see that their share price in 2013, they actually dipped because of the negative earnings per share, and when they turn positive, their share price shot up, and their share price go up and down. And in recent years, their earnings per share decreased, and they went to negative region, and you can see that their share price actually decreased all the way down. So like I said, it proves that the earnings per share grows in tandem with the share price. Next is, I want to really emphasize on the level of EPS, what we call high quality EPS versus low quality EPS. So what we mean by high quality EPS is that the net income is consistently increasing while the earnings per share is consistently increasing. This is what we call good quality earnings per share. Next is what I call low quality earnings per share, is where your net income is stagnant for the company, whereas the earnings per share is consistently increasing. So this means that the company's growth is funded through share buyback by the management. So actually the business is just performing okay, but because of the share buyback reducing the share count, the earnings per share actually increase. But I'm not saying that the low quality EPS is no good. Both of it, the high quality and low quality, are actually okay and they are good. But for us as an investor, we want to prefer high quality EPS where the net income increase followed by the earnings per share increase. Why we want to focus on high quality EPS is because there's a double boost. Okay, for this case of low quality EPS is that the earning growth has slowed or maybe stagnant, but the company is growing fast because they are buying back shares. Whereas imagine if you are buying into a company where the net income is consistently growing and the EPS is consistently growing, and the management still got extra ammo to buy back the number of shares and speed up the growth in earnings per share to push up the growth in the share price. So that's why I say we want to focus more on the high quality earnings per share, because they can be a double boost to our returns. By now, you should have a clear understanding of what earnings per share is and how to use them for your investment needs. So some key point you want to take note is that look for companies with growing earnings per share, avoid those companies with decreasing or lumpy earnings per share. And lastly, you must collect at least 5 years worth of earnings per share data. And now if you are into investing and if you want to find out more about how you can find companies that can compound your money 10 to 20% a year, we have a free training for you at The Quadrant Strategy. So you can find the training link in the description box below. It's a 16 minutes video that we teaches you how to invest for profit. So get yourself registered for the training. And finally, if you like this video, do remember to hit the like button below, share with your friend, and don't forget to subscribe to the channel for more videos and updates. Once again, thank you for watching, and I'll see you in the next video.